do you guys think any of the type of stuff that's going on in France specifically could affect equities? Mike, you don't have to answer it if you're like, I don't know, I look at charts, but I'm just wondering both your opinions. You see the kind of things going on in France or France, if you want to call it that. Do you think any of that could affect here? Or does it have to be much more widespread, much more serious for that to
So
happen?
my answer to that would be, after we saw the series of videos supposedly from China in winter and early spring of 19 and 20, I'm not even sure I believe the videos anymore. I think there's a ton of bullshit. I think there's something going on that's bad in France. I don't know how bad though, so I don't have an answer to that because I don't trust the videos that could be propaganda. I need to hear from someone on the ground who I trust. Mike, do you have a thought?
Again, if
the chart, blah blah blah.
No,
Yeah,
but
this is
here
stocks now.
we do have, the only thing. Let me just tie this into the S&P because we have potential topping patterns in all the indices, all of them. Potential again, but if they were to trigger, yeah, they are daily topping patterns, but that we could see pullbacks to like 4250 in the S&P. Is that the kind of pullback you're talking about, or are you talking something bigger, Bob? I mean,
I don't know.
Welcome to the Futures Edge podcast. I'm Jim Uriel. As always, brains behind the operation, Bob Iacchino. And my favorite podcast of the month is when we have Mike Arnold, Chief Technical Strategist for Path Trading Partners. He's made me a lot of money. He's saved me money from crappy entry points. I very much appreciate it. I think I owe you dinner next time I see you, Mike Arnold. Thanks for joining us.
Thank you for having me.
Okay, we wanted to talk first about some fundamentals, market fundamentals, before we dive into the technicals. Bobby, I've been wrong about why the stock market is going to rally. I haven't been wrong that it's going to rally. I have been wrong about the sectors. I thought commodities would do better. But I thought the stock market would rally because I thought the Fed was going to pivot because I thought a recession was coming. Recession doesn't appear to be coming. What the hell's going on?
Yeah, and I've been wrong about the direction of the market while I've been right about what was going to happen with the short end of the curve. And, again, I would argue that your wrong is better than my wrong because you can actually make money on your wrong. One of the things I always say is that there's three possible outcomes to a trade: a win, a loss, and a break even. And two of those are good. And I have not participated in this rally, so I haven't lost money on it. I just haven't made money on it. And it's much easier to kind of survive that. But I think that maybe because I still do believe a recession is coming, and I think equities have yet to adjust to that recession, that I'm probably still going to end up being right. But I think with the amount that the stocks have gone up, it's almost like not being right. It's almost like a completely different opinion that this rally isn't going to last, rather than stocks are going to go down.
Okay, so Mike Arnold, I'm going to ask you about something. CME and Bloomberg asked me to do some research on the cardboard box index today. Are you familiar with the cardboard box index?
I am familiar with the cardboard box.
Okay, so supposedly Alan Greenspan cared a lot about the cardboard box index. Basically, it's this for people who aren't familiar with it. 95% of the products shipped in this country are in corrugated cardboard boxes. The paper mills, the retailers, the demand for those things has absolutely plummeted at the steepest rate since 2008. Even stocks like International Paper, WestRock, I think, are the two biggest producers. They both have posted poor revenues. They're down 10 and 20% respectively, while the stock market is up, considerably over the last quarter. Do you believe, Mike, that this is a solid indication that a recession's coming?
I do believe a recession's coming. The timing, as always, is the hard part, and the thing I start watching before I can get very aggressively short. There has to be a major pattern that triggers, or we have to see that I watched that 10-2 yield curve real closely, and we have to see a rapid climb back to the zero and passing that zero mark, because historically that's when the market tends to crap out the fastest. So We have not had that. We've had.
Can you repeat that? When what goes beyond zero?
The 10-2s, when the
Oh,
10-2 yield curve, most people watch for it to start going up. But once that really starts getting towards the zero bound, up on, I could put up the long-term one. Once this really starts getting close to the zero bound and then accelerates 0.5 to 1, you generally have, that's when the market's at the biggest risk for historical downside moves. Now, we're not anywhere even close to that zero mark yet. I put up the chart on, that's a weekly chart. What's interesting is we do with this retest of the lows from the March banking crisis, the minor March banking crisis, we now do have a minor potential double bottom on the 10-2s, long way off from triggering, because we'd have to get a trigger with a weekly close above minus 26.8 basis points. But if we look on here, if this were to trigger in the next, and this could stick around for a monthly pattern, so this can stick around for many months. And if we get that close above minus 26.8.
But I got a quick question to interrupt you. Is that dog saying they agree or they don't agree? What kind of bark is that exactly?
That dog's complaining. The next door neighbor sold their house and they're moving out. They're getting out of Illinois, and that dog's rooting them on.
Okay, all right. That makes sense then. Okay. But anyway, I did not mean to interrupt you. But then go on.
No, so this might never trigger. We could just keep going down with the 10-2 yield curve further negative. But if this pattern were to trigger, the first target would be 15 positive basis points, and the final target would be 50. And that could be the eventual trigger that really could put in a major topping formation in the market. And then we could have minor topping formations before that, but I'm talking something significant. And just to tie in, funny enough, and I don't know if this will ever trigger, and I don't count on patterns this far away, but this is monthly S&P. And with this last push up from June, because now what is it? We're recording in July 5th. Theoretically, if we got a monthly close below the lows from last October of 22, we could trigger a massive double top pattern in the S&P. Again, we might never take out those October lows at this point, but if we start accelerating that yield curve back up and we did take it out, we could see a fairly substantial market pullback, a lot bigger than anybody could be expecting.
Bobby, I'm not going to ask Mike this question because I know he's going to say it just does. I can't get my head around the fact that historically, as the yield curves goes back above zero, is when, and I know it does. I've done the research too. I know the stock market tends to crack then. Do you have a fundamental reason for that? Or is it just one of those things?
I do. Good. And okay, so first of all, you'd be looking at, generally when we get an inversion, after that we get a bear steepener in yields, not a bull steepener. And it would make sense, right? We get an inversion, we get a recession, the Fed stops hiking, and they start cutting aggressively to try and get us out of a recession. So if you take an example of where the 2-year closed today, it closed about 494, so almost 5%. The 10-year closed at about 395. So we're talking about 99 basis points on the 2s, 10s to the negative. What you could see in Mike's scenario, you could see a 2% 2-year and a 2.5% 10-year. That's what I mean by a bearish.
Because they have to start. They have to start easing quickly.
Yeah, and they just all collapse. And the only way that they would all collapse is if the Fed is not only looking to ease, but probably has begun already, and B, inflation is down, so the long yields can collapse as well. Okay. Otherwise, you have a really big problem where the long end is rising and the short end is falling, and that's not going to be good to have. I mean, it's a normal shape of the yield curve, but the normal process that a recession brings about is a bearish yield steepener, not a bullish yield steepener.
Okay, I love that answer. Thank you so much, because that clears up some for me. So what do you have here? What's that chart you have on here, Michael?
Oh, this is just the 2-year yield that Bob was talking about. And But there is a potential pretty big topping pattern in that, but again, might never trigger. And it's closing in. It just hit the statistical probabilities by hitting 4.89 again. But if it breaks above the March highs, then the two intermediate targets would be 5.25 and then 5.4. So we could still see some upward price action in the 2-year. The 5-year is just closing in. If we get a close above on the 5 years, 3.93, we should still, then the probability shift, again, no guarantees, but the probability shift drastically, that we could even get to about 4.2 and see the yield area from last October, before the big pullback into the lows this April. So I'm keeping a close eye on that.
If we could, Mike, if you can pull up the CME Fed Watch tool, this is what I was talking about, where I said, like, my view on the Fed has been right, but my view on the equity markets has not panned out. After the May Fed rate hike, we all know that in June they paused, right? Or skipped, whatever. After the May Fed rate hike, they started to price in, and by they, I mean the Fed funds futures markets, represented by the CME Fed Watch tool, started to price in the highest probability being a 25 basis point rate cut in July from the current rate. Since then, and I said at the time, I go, this is going to slowly get priced back to normal.
You did. I remember you saying it. Yeah.
Yeah. And that, because it didn't make sense they were going to all of a sudden shift back to cutting when you still had inflation well above their target and you still had really strong employment numbers. I mean, the country is still working. Now, I would throw in, thank you to Mike Singleton from Invictus Research for this, that we're starting to see cracks in the unemployment claims, for example. The 4-week moving average has hit a new cycle high on claims. Even though last week was lower than expected and lower than the previous week, the 4-week moving average, obviously it's volatile week to week, was up and has hit a new cycle high. So if you look at what the CME Fed Watch tool is doing now, it's pricing in a hike in the July meeting and then no rate cuts going all the way out till, I believe, the end of the first quarter of 2024. There's the probabilities tab. Right now, they're pricing in the highest probability of one more 25 basis point hike in July and then holding that all the way through March of next year. Whereas after the May meeting, they had a rate cut in July. So the market is starting to price that in. Stocks have not looked at this and been afraid of it. And maybe that's the right thing. But if we start seeing cracks in the jobs market, who knows? Look, something you've pointed out, Jimmy, time and time again, is that AI could be the new internet, and it could actually wipe these theories aside to a certain degree, where AI starts to increase productivity to a level with which we don't actually end up with a jobs recession, in which case this could happen and stocks could continue to go higher. They could.
I bet you and Cameron Dawson 2 weeks ago that the Fed was done hiking. I believe that I'm going to lose that bet. I'm fine with that. And again, it's a lot of money. It's $1 each of you. I think, though, with some accounting sleight of hands, my wife won't even notice. My question to you is, it's July 5th. The meeting is July 26th. What could happen to make me right?
There's only 2 pieces of data that could change that, right? We get one more set of inflation data, one more non-farm payrolls before that meeting. And that non-farm payrolls is this week.
The PPI number in Europe came out, and it was huge to the downside. Now, granted, that's more commodity-related PPI. If we see just a huge plunge, could that put them in as another skip?
I don't know. Well, it definitely could put them in, they could skip again. The FOMC minutes, we're recording on Wednesday. This won't be released till 3 or 4 days after that, 5 days after that. But we just got the FOMC minutes today. And it turns out, if you look at the minutes, it was heated. I mean, there was actually serious discussion about raising rates again. And it seems like they all kind of came around to, okay, we can skip this one, but the verbiage needs to be strong that we're probably going to hike again. One of the things, we had Jim Bianco on the show a while ago. It's probably time to get him back on, because I watched an interview of his where he basically said that the base effects are going to bring inflation down to 3%. If you remember last year, a month from now, we had a 1.2% month over month inflation change. And then we started going with these 0.3, 0.2, 0.3. That 1.2% is very difficult to jump over. So when we get that matched up on a year over year basis, inflation is going to drop, and it's going to drop dramatically. And that is probably the last hurrah for stocks. I don't know. I could be wrong. I've been wrong. But when you look at it from that perspective, he goes, then after that, the comparisons start becoming 0.2, 0.3, 0.4, and you can slowly rise, especially on the core again. The second part of that would be kind of answering your question. Even if we see weak inflation numbers at this next batch of data, I'm not sure that it changes what the Fed is doing, because maybe they think the same way Jim Bianco does, where now you're seeing natural gas is starting to climb, right? Because there's been quite a bit of demand based on heat. Everyone always thinks about winter, but there's quite a bit of natural gas-fired air conditioning, and we've had a heat wave. And that's starting to suck up supplies and surpluses. And then we're going to go into the winter. OPEC and Russia sure seem convinced they can bump up crude oil. The market isn't convinced of it at all. And if you start to get a little bit of a spike in energy on the heels of the base effect adjustment that Jim Bianco talks about, there could be a problem. And I think the Fed might be looking at that. I think the jobs number, Jimmy, is more important. I really do. If jobs start to show cracks now, then you could get that pause and you can win that bet.
Michael, can you walk us through that? I'd love that you put up that natural gas chart. I look at it and to me, it seems like there's a lot of potential for the upside. I'm sure you're going to tell me I'm wrong, but let's have at it.
You're not always wrong, Jim.
Okay, good.
It's been that was a weekly chart. Here's the daily chart. It's been grinding higher. It did break above a very key resistance level on June 23rd, Friday, June 23rd. Now, as long
it's my birthday.
Is that your birthday?
June 23rd was my birthday, yeah.
Well, happy belated birthday.
Lovely. Thank you so much. But anyway, go on.
You can finally drink legally.
If it can hold this about 255, 256 level and start basing up here, it could form a higher base and then be ready for a breakout. Now, the real interesting area on natural gas that I'm watching is roughly the close above $3, because on any short-term bullish upturn, $3 is $2.98 to about $3 is my first target. And then if we get the close above $3, it moves into a massive clear path move. The weekly 200 and weekly 50 moving averages is the first key target on that, which would be 378 area. So we can see a quick pop. Don't know the timing on that yet because it's still trying to build that base up here. If we lose 255, then we're back into the lower consolidation range, and it's back to the drawing board in the short term.
Bobby, what do you think? And I want to actually, outside of the show, go over this with you too. What do you think about an options trade where I sell like the 280 or 290 calls once, and then buy two of like the 320 calls above it? Backspread being that if we go through those levels, it starts to accelerate. Give it a couple months so I won't, lose deterioration so quickly in the deferred one. What do you think on that?
I haven't looked at it outside of looking at the current pricing and the volatility and everything else. I like the concept of the trade. I do, because even if it does break out like that, we all know that in most commodities and stocks as well, the downside is much more aggressive than the upside is. And you certainly will see if natural gas, save for some sort of emergency, right? Some sort of, I don't know, if Russia actually uses low-grade nuclear or something like that, you're likely to see it grind like this higher as we get in toward the winter rather than spiking higher, which would obviously, be have a different effect on the options. But I like where you're pointing out. I just, what worries me about the natural gas trade is just in general is that we're starting to base at a time when natural gas should be pretty stagnant if you look at it seasonally. It should be pretty flat to lower. And we're starting to base because one thing you learn when you look at seasonality a lot, and I'm sure the both of you have, is seasonality is a horrible trading strategy because it shifts. So what I mean by shifts, if the seasonal, I'm not saying it does, but if the seasonal natural gas sell-off generally happens in April through June, and it happened earlier like it did on the chart, it tends to shift the move higher earlier as well. And that's the one thing that worries me a little bit. But I do like that trade because I don't think it will just shoot up, barring some sort of shock to the system.
If it did shoot up, you were ratioing it, right?
Yeah, I have the 2 calls above. Right.
So, yeah, I mean, if you can finance those 2 calls by selling the one lower, and then we do get something that takes off, that,
and usually the way I do it, not to get too into the woods, but I'd make that, sell the one, buy the 2 calls, and then maybe sell a call up here and have all this. Again, that's my very sophisticated measurements of my, but anyway, I'll put that out on Twitter if I decide to do that trade. So, Mike, what do you think?
Let me ask you guys just an out of left field question, because I was just looking at some headlines and seeing what Marine Le Pen said in France. Do you guys think any of the type of stuff that's going on in France specifically could affect equities? Mike, you don't have to answer it if you're like, I don't know, I look at charts. But I'm just wondering both your opinions. You see the kind of things going on in France, or France, if you want to call it that. Do you think any of that could affect here, or does it have to be much more widespread, much more serious for that to happen?
So my answer to that would be, after we saw the series of videos supposedly from China in winter and early spring of 19 and 20, I'm not even sure I believe the videos anymore. I think there's a ton of bullshit. I think there's something going on that's bad in France. I don't know how bad, though. So I don't have an answer to that because I don't trust with the videos that could be propaganda. I need to hear from someone on the ground who I trust. Mike, do you have a thought?
If
the chart, blah, blah, blah.
No,
yeah,
but
this
here, we do have, the only thing, let me just tie this into the S&P, because we have potential topping patterns in all the indices, all of them, potential again. But if they were to trigger, they are daily topping patterns that we could see pullbacks to like 4250 in the S&P. Is that the kind of pullback you're talking about? Or are you talking something bigger, Bob? I mean,
I don't know. It used to be that we used to, going back to the 2000s, we used to pay attention to geopolitics, obviously because it was post 9/11. And, we saw the train bombings in Madrid and London, and those things affected markets, but they affected markets less and less each time something happened, right? 9/11 was a massive effect. We came back from that. I think Madrid happened before London. If I'm not correct about that, someone let me know. And then, the train bombing and the markets were affected, but not as much. And they came back. Same thing with the London bombings. Markets were affected, but not as much. And they came back. And to a certain degree, I think people kind of get numb to these things. In the same way that during COVID, and I would argue even now, people get numb to the fundamentals of what's driven stocks in the past until it punches them in the face. And it's probably that, Mike and I talk all the time about it's just buy the dip again. Doesn't really matter. Fundamentals don't matter. Earnings don't matter. EPS doesn't matter. PE ratios don't matter, even though we all know they do. Right now, it doesn't feel like they do.
Nothing matters along that side. And I agree with what you're saying. The market seems to shrug off everything right now. It might react to a day or two, but then it's like, okay, bye.
I still think that's a function of the fact there's still $2 trillion extra liquidity, even if we stayed on the slope of raising M2 money supply from where we started in fall of 2011. If we stayed on that ridiculously high slope, it's still $2 trillion more as a relic of the $7 trillion that was pumped in unceremoniously as a response to the COVID-19 mitigation. But I think that. But anyway, I look at this
S&P from
chart.
GoFuel, by the way, watches our podcast. You guys should reach out to me. This stuff is so good.
It's called GoFuel. What is it? Caffeinated?
Goat.
Goat fuel?
Greatest of all time. Goat.
And is it caffeinated?
Yeah, it's got caffeine, but it's got like mushroom extract and stuff. I don't get the shakes from it. I don't get palpitations, but I wake up.
If you guys watch our podcast, if you guys send me some of that shit, we'll talk about it all the time. I want to give it a try as well.
I didn't know
that's the last time I'm going to talk about it publicly.
By the way, can I tell you guys a quick funny story that lasts about 1 minute about you said about the London bus bombings? I haven't really spoke about this publicly in 20 years or whatever it was.
Sure.
But 3 days before it happened, I get a call from a client in London. And I know exactly what the transcript said because the FBI went over it with a fine-tooth comb. He said to me, Jim, if I had prior knowledge of a terrorist attack, how would I profit from that? Now, at the time,
oh my God,
At the time, we were in terrorist world. So this was an odd question, but not as ridiculously odd as it would be right now because everybody was on pins and needles post 9/11. So I said back to him, do you mean how do you protect your positions in case of a terrorist attack? And he goes, yes, right, of course. And then I went over some trading strategies with him. 3 days later, bus bombings in London. I immediately called my supervisor. I can't remember where I worked for. Feds came in, got all our stuff, all our transcripts. I hope I can talk about this now and not be led away in cuffs. But they don't tell you whatever becomes of it. And I never spoke to that client again. But anyway, let's go back to the S&P.
I'll tell you guys a funny London story, and then let's do the charts. I was sort of a junior guy on the phones in the bond pit. We had a squawk box going to our London office, right? 4 or 5 pretty big London traders. It's a Japanese institution. Mike, I may have told you this story. And it was July 3rd, and July 3rd was going to be a half day. It's getting to be around lunchtime, and I shout down, hey, just a reminder, guys, half day in the bond market today for, July 4th holiday tomorrow. And this one guy, his name was Nigel or Spencer, or I don't know, one of those names in the UK. And he comes on, he's like, yeah, Bob, thanks for the reminder. You have a good day. I go, yeah, you too. What are you guys doing for the holiday? Silence. And then I go, oh, shit, you probably don't celebrate that, do you? And he goes, no, it's kind of a sore spot, actually. Anyway, go ahead.
Good one. Oh, Mike, back to the chart. Oh, yeah, back to the podcast we're doing. To me, I look at that 4,500 level, and I think a settlement above it, particularly after unemployment on Friday, and it looks bullish to me. Where am I wrong on that?
The only thing that puts me in bearish mode is a close below 43.68. Otherwise, if we got a one-day pullback, if we get a little more, I'm watching for a potential basing above the breakout level from the middle of June. We pulled back, retested it today. Again, this is Wednesday, July 5th, but this could also be forming a little cup and handle. And probability-wise, still says we could see some higher prices. Now, the only negative is on a cycling basis, we have daily cycles should be topping this week, and weeklies are headed down. So I am watching for that bigger pullback, but so far it's been shrugging off any bigger pullbacks. That's why I need that close below 43.68. If we do break out, the next major target is 45.75. And then to statistically complete, remember when I talked about on the last podcast, last time you had me on, if we closed above that 43.18, the first target was this 44.80, which we're now basing at. Right now, it's closing at 44.82. The next minor target, 45.75. The next major target is about 46.45 area. If we do break out, those are the two targets I will be focusing on to the upside. And unless something does roll over, and again, when cycles are in a topping pattern on a daily and a weekly basis, I do prepare myself for pullbacks, but I need something to trigger.
Interesting.
Hey, Mike, can I point something out to you, Jimmy, on the daily chart on the CS, and then we can go on to the next one unless you have another question. If you zoom into that recent activity there, right? And Jimmy, you said it looks like those two tops kind of held there, right? And I assume you're talking about June 15th and June 16th. Okay, so a lot of people will look at those highs, and that's a mistake. If you use candlestick charts, you need to look at the bodies. I mean, a spike high can happen. It can be a mistake. It could be a low volume day, and some big player comes in that has to hedge, and you get a spike high. And the market will correct to where the market should be based on closes and opens. So if you look at the high of, say, June 16th, right, we broke that on the 30th. And then we broke it again barely on the 1st, and we closed below it both days. Today's the real pullback test, where we got back down to the close of the 15th and the open of the 16th, and we moved back above. It's a very specific difference, and it's an important difference. And part of the reason Mike and I look at that rotation zone, which is Mike taught me the rotation zone, which is those two moving averages, is it's a much more stable pullback, right? As opposed to just pulling back to two little wicks that may or may not have mattered in the grand scheme of things. I just wanted to point that out.
No, I like that a lot. What commodity do you want to move on to, either Bobby or Mike?
Well, Mike, you want to just quickly go over the other indices topping patterns,
Sure.
and then we can move on to maybe gold or yields.
Yep. Yeah. This was, again, we covered the S&P. And if we got that close below, I just want to retouch on this. If we got that close on a daily basis below 43.68, that's only a potential pullback to about 42.44. Now, if we triggered that and we started pulling back more and fell through that, that would be fine. But that's not something where, oh, we've triggered that, we're taking out October lows from from last year. So again, all these topping patterns are minor. I mean, recently they'd probably be the biggest pullback we've seen in a few months if it does trigger, but there's no guarantee that they will trigger. The NASDAQ would need a daily close below 14,853 area, and that could be a pullback all the way to 14,281. The Dow, again, you can see all the topping patterns, and the Dow could actually pull it back if that closes below 33,855, all the way to the flattening out 200, which would be a target area of about 33,000 to 33,050. And the Russell would need a close below 1825, and the highest probability target would be about 1755. So you can see across all those that, again, none of them may trigger, but it is something I'm keeping a close eye on, and I don't know what shift would have to take place from a fundamental standpoint to cause any of this to trigger, but it's better to be prepared, especially if you want to know, hey, from a more recent trailing level, where should I potentially put a stop, or where should I put hedges that would kick in? Well, that could be some interesting levels to consider. Yep.
Yeah, actually, if we could, since we're talking about equities, let's go to the XLF, because I found the financial sector to be interesting today.
XLF, you said.
Yeah, the
XLF.
XLF. Which, Jimmy, you are not licensed to talk about.
I'm not licensed to talk about equities.
And you're not, for the record.
Right.
But I just found this interesting because financials was one of the sort of things that broke the market last time. And I see this as a fairly positive market. Mike, where am I wrong?
It is still positive unless the XLF closes below 3250. If it closes below 3250, I would not be positive on the XLF. Now, to touch on pretty much what you touched on before, a key basis, XLF could pull back. It's basing above a major support level, which was formed in the middle of April, which comes in about 3340. And we have the rising daily rotation zone. So as long as we don't really get a close too much below that, it could stay in short-term basing mode. The key level, though, that I'm really paying attention to in the short term, if we get a close below about 34.15, then the targets are 34.60, and a close above 34.60, the next target would be 35, and then the market could probably just keep marching on.
Mike, I have a question for you about the XLF specifically, and about ETFs that are dominated by, let's say, like the dollar index that has 7 major currencies in it. My point is that when you look at a chart, because to me a chart is a photograph of like what the crowd believes and momentum and where people will blink. When I look at the XLF, I see, it's Goldman, it's JP, it's Morgan Stanley. It's all these things that are individually traded, and then we're kind of ring fencing them in this isn't traded as much as those individually. So is this less likely to follow technicals than an individual stock would be, or no?
The probabilities do shift down a bit. However, for major patterns and major levels, they still stick in place enough that they can be utilized.
Interesting. People are watching saying, well, the S&P is just 500. The S&P and the SPY and the ES are so heavily traded that I think it completely doesn't matter that they're just an amalgam of a million stocks. But these ones that are 10 to 15, to me, it seems like it's interesting discussion.
Can I bring up one other thing if we're on stocks?
Yeah, go.
Sure.
It's sort of the custom index. I call it the big 5: Apple, Microsoft, Amazon, Google, NVIDIA. And that's on the equal weight basis, because I'm not going to try to get fancy with it. But it has hit the level to put in a potential double top also. Again, never has to trigger. But just watching the big 5 group, that can be topping also something that's led higher. The semis. which finally and it's trying to top out here. But since the middle of June, it's formed an interesting head and shoulders pattern, and it statistically finished the probability set from its highs in December 21 to the lows in October. Again, when it closed back above that 62.5, it should have targeted this 150 to about 160 area, and that is where we formed a potential head and shoulders. Now, is that something that's going to take it to October lows? No. But we have something else that's been leading drastically due to AI and everything else on the way up. And we also have a topping pattern in there. So those are things I'm just keeping an eye on. It's a lot of things that are getting into potentially toppy areas.
I want to point one more thing out about that XLF. And I'm doing this for viewers that are watching this. Notice that when Mike talked about the XLF, and you can rewind the recording now and look, Mike did not mention the 200. That's because the 200 is very flat. And so the thing about moving averages is when they flatten out like this, they are much, much weaker. But you'll hear it on financial news all the time. It's like, it's above its 200. It's like, well, I don't even care that much about the 200 right now because it's virtually flat. So 200 might be a little stronger than the other ones. But
do you have a fundamental argument for why bank stocks should rally? Wouldn't it be economic sensitive?
Well, I mean, to me, it would be the potential steepening of the curve. But I also think it kind of falls into, I remember people telling me when or people asking me when the regional bank crisis was happening, should I buy Western Alliance? Somebody told me it's going to double. I'm not buying it, but go ahead.
If it's going to double, you should definitely buy it.
Exactly. I said, I'm not buying it, but go ahead. I would rather put on a larger position when I have a pattern than bottom fish and double like. I think just as long as you see, bank stability the way it is, the financials are going to respond to that. And we just got the stress tests, and the stress tests were all positive, and people still believe that the put is there for banks specifically. I guess it's more of a why wouldn't it rally? But
one more quick question, you can just answer yes or no about it, and then we'll move on to maybe oil or gold or whatever. But is a thesis I posited on the Kudlow show on Saturday was that they've been pricing in a recession. The recession is being taken out, so it stands to reason that the bank stocks may bounce back a little bit from where they were priced. That's relatively reasonable, right?
Yeah, I think that's reasonable. Again, I think with if the Fed's going to hold rates, it's got to be theoretically, if the Fed's going to hold rates higher for banks and the banks are still doing okay, then yeah, I mean, you go back in, you say, okay, the crisis is over. No matter what they do at the next meeting, we're at the end of the rate hike cycle. Right?
Yeah, right.
It's either one or two more. And that's going to bring about stability, which means you would bottom fish with some of the good banks. So yeah, I think that's reasonable.
All right. Gold. I'm still watching for a longer term bottom. We don't have a longer term bottom pattern yet. If we do close, and we did not close below 1913. If we close below 1913, I'm going to be watching for a pullback to the steepening 200 and also the breakout level the breakout level from back in March from our little when we started getting into the banking crisis, coming in right at that same area. So that's what I'm watching for if we do continue to break down, and then I'll be watching for a more substantial bottoming pattern in that area.
The fact that it traded to 1900 and rejected it swiftly and violently that day, does that mean anything to you, that particular price action? Ticked down, and then it was like, nope, got to go, and headed higher quickly.
It was just, we were getting to oversold. We had some divergences here. You see, it's also why I follow the rotation zone, which Bobby brought up before. Again, it bounced back in the rotation zone, rotating lower. Now, the only other thing that could shift my mindset, even if we do close below that 1913, is if we put in a daily double bottom pattern, retest those lows from June 29th, they hold, and then we break back above about 1943 and close above there, then we'd be out of the way of the daily rotation zone. We would have put in a shorter term bottoming pattern, and then I'd be watching for that to play out and then possibly roll into a larger bottoming pattern, because we're getting into a more substantial level where we could see a major bottom in gold, but we don't even have a minor bottom yet.
Yeah, no, things go in order like that. From, minor bottom before you can get a major bottom, major or
Right.
minor top before you can get a major top. Because I'm still in the recession camp, and I love that people are leaving the camp, because one of the things I hated the most about saying there was going to be a recession was that everybody was saying.
Right.
We know that that's not when these things happen. I was watching somebody today on one of the financial networks. The guy was like 100 years old. So he's been doing this forever. He basically said something that resonated with me. He goes, the yield curve works. It works. He goes,
Well, I
it's
believe
one
that
of the
too.
things out there that does work. Now, it's not a timing mechanism, as Mike just said about some of these patterns. The timing of these things are very difficult. And, we've never had manufacturing ISM, the PMI figures, ISM manufacturing PMI at 46 without a recession, except for one time. We were already in a recession every single time the ISM PMI was 46 or lower, except for one time. And it was 1996. And what I committed to doing, and that's again from Jim Bianco, and what I committed to doing was saying, okay, let me go look at what else was going on in 1996 and see if any of that compares to here. And I didn't do it yet, so I don't have any insight there. In order for gold to do better, the yields have to start coming down. We don't have that yet.
Right, because Bobby, I think for people who are watching, I knew exactly what you meant. When he's talking about the recession, he's saying the recession comes, the Fed all of a sudden gets looser, some of that liquidity ends up in gold. That's the tailwind that gold needs.
Yep.
Okay, good.
Finish on crude. Overall in crude, nothing's. We only have some minor patterns that are playing out right now. I mentioned, before, if we got that close below the 200, that's the only thing that could take me bearish in the short term. We've tested that level. Here's the weekly chart, and this is the weekly 200. It has not closed. We got March. We got two tests in March with the close holding. We had a test in May. We had a test again in May. Then the last 3 weeks prior to July 3rd week, all tested. So that is the key area. I'd give it about 66.90. You let it close below that. That's the only thing that makes me bearish. Now, does that mean I'm overly bullish? The only thing we've had in the very short term is this will probably be done tomorrow, but a minor bullish pattern. I really need to get a close above the area around 74.30 before I could see potentially shifting up to a higher basing pattern. So any continued rally, my real target area is about 74.30. We start getting close above there, then I'll start targeting around 77 to 77.50. Is that a major breakout? Does that mean crude's going to rip? No, there's nothing on the horizon yet that says crude's going to just, even if it forms a higher base for a while, that's all it's done is form a higher base, and it's still in a trading range. So everything from my perspective has to be based off shorter term patterns. Again, unless we break and get a weekly close below 66.90.
The fundamental story.
Yeah.
So Saudi's talking about perhaps cutting production again. I saw two different articles on it. One saying that should be supportive of crude prices. Another saying, well, that they're anticipating a global recession and that's why they're doing it. Ultimately, I would think it'd be more of a tailwind than anything else, right?
Yeah, I mean, the production cut can be a tailwind, but what's interesting right now is generally what drives the ebb and flow from a volatility expansion perspective are shocks in crude oil. And I've talked about this for the last 10 years on TV and elsewhere, is that the characteristics of crude oil is that it trades in channels when supply and demand is roughly balanced with a slight lean to one side or the other. And right now we've got a lean to the downside, right? And until we get a shock to the system, and those shocks are usually to supply, they're very rarely to demand, especially to the upside. You don't all of a sudden get, oh my God, demand has exploded. That's what people were expecting with the China reopening. And Mike just highlighted one of those sideways periods of time, right? You're talking from basically middle of November through the middle of March, where crude was just sideways. We're in another one of those patterns right now. And again, for us to see a demand shock, it would have to be something like China reopening, which was wildly disappointing in the most positive sense. So it's usually a supply shock of some sort. Now, how could there be a supply shock? Russia starts losing badly, maybe something in that effect. Somehow Saudi Arabia or one of the other major producers like the UAE, Iran, Iraq get into some sort of conflict. They're usually military in nature. Those would be the things that could be a supply shock that could really affect the market, false flag or not. Right? Those would be the kind of things that would do it. So other than that, outside of that, you're seeing basically a sideways channel with a tendency toward weakness, and that's not likely to change. Now, if you go back to the weekly chart, Mike, there's an interesting thing. When I had my commodity pool, okay, I had a partner in the commodity pool who was a quant guy, and he had built what he called VX, which is volatility expansion model. You guys will understand this. I'll try and explain it in as plain English as I can. Every single entry in this model was a stop in, because what happened is every day we put a stop to the upside and a stop to the downside. And as volatility compressed, those stops got tighter and tighter and tighter day after day after day until there was an explosion up or down. And we hope to get long or short with those stops on explosions. We traded that for quite some time. That's the model that got us long interest rates on 9/11, believe it or not. So it was a wildly successful trade on just a horrible day. The weekly crude looks like that right now. It looks like it just keeps compressing and compressing and compressing and compressing, especially the last 7 or 8 weeks, where the ranges are just getting tighter and tighter and tighter and tighter. I have no prediction onto when this is going to break out, but this is likely to snap in one direction or the other. And again, because demand is driving things right now, it's very difficult to get a demand shock. I suspect the direction would be up. I have no trade, not telling anyone to get long. As a matter of fact, I'm telling you not to get long off of what I just fucking said. But I'm saying, these things compress and then they blow. And that's true of many, many markets.
Cool. All right, you want to leave it there?
That's it. We've covered it.